This is the Texas Land Guys podcast, hosted by brothers Tim Dosch and Tom Dosch. With their partners David Marshall and Tripp Rich, they have built DMRE, the leading land brokerage in Texas. With decades of experience brokering deals between landowners and real estate developers, they take you inside the deals that move the market.
All right, well, welcome to the Texas Land Guys podcast. Tim and Tripp, how you doing today?
Doing good, man.
Doing good.
It's good to have both of you on. It's fun to have all three of our studios running and on the same day.
We got the full Texas Triangle covered, so that's good.
We do. We were talking about what we'll talk about today, and we thought that it'd be fun to discuss what we're seeing in our different markets and some of the different conversations we're having with landowners and developers, and how maybe the answers that we would give to some of these scenarios we're running into would be the same or different depending on the markets we're in. But before that, I wanted to quiz you guys a little bit. I was listening to a podcast on the way in this morning, and they were talking about longevity. And I know both you guys are big into health and fitness and longevity. And so they were saying, like, what is the average person, and this is based off surveys, like what does the average person think has the greatest impact towards your longevity? And then they're like, what actually does? So I'm interested in what you guys would say.
What the average person thinks contributes to longevity, and then what actually does?
What actually does, yeah.
My guess is that people might think it's exercise. That would be my guess. Some sort of like running or cardio would be my guess.
What do you think, Tripp?
Yeah, my assumption is that average person would think that it's probably exercise.
Yeah, so it was what you just said, Tim, was cardiovascular exercise was the number one. And then what actually do you think has the biggest impact on your longevity?
The biggest impact, I would say, is diet. I mean, I think it's hard because you can't just pick one, obviously.
Yeah.
Strength training is huge. Cardio is valuable. But diet, I mean, if your diet's just terrible, it's going to be tough. So.
Tripp's smiling over there. Yeah.
Tripp's like, I got the real answer.
I honestly, I was
trying
just right with Tim. I was like, well, man, it's longevity, like walking, like, yeah, cardiovascular. Like, I'm probably the average, but yeah, my guess was the average person thinks walk or cardiovascular exercise, and then probably food. So yeah, diet. But you're smiling, so I think the answer's wrong.
Well, it's very interesting. So the average person does think that it's cardiovascular, but actually, one of the things that the studies show is there's a lot of studies around running and cardiovascular health, and so it actually can be a negative, is what they were talking about. So because it stresses your body so much. So like, yes, it is good to be active. And so there's a limit to when it's going to be really helpful for you, but then actually it starts to really become a negative if you train too much. And so if someone that's tracking, and trying to perform could actually really impact their longevity. So they talked about the things that are really important for longevity would be, like you said, Tim, diet. But the hard thing about diet is it's hard to study because it means so many different things. But diet's really important. And they said it's the combination, sleep, stress management and sleep.
That's what I was going to say. It's not one, sleep's really important, stress.
I was like, I don't know if they can, I'm really interested to hear what you're going to say, because I don't feel like it's only one.
Well, what's interesting about it not only being one is they said it's accumulative. So if you're doing multiple things, so if you're good, healthy diet, if you're moving and active, if you're strength training, and so if you're doing these multiple things, it actually has a cumulative effect that's greater than like 1 + 1 + 1. It actually accumulates to a larger impact. So even another one would be sauna. So there's a lot of studies on saunas coming out of like Finland and Norway. And they did a study over 20 years. This is one of the stats I remember. They did a study over 20 years, over 2,000 people, and there was significant gains to longevity for those that did the sauna at least 4 times a week compared to those that did it once, which I thought was interesting. But that helps with stress management too. That's also a cardiovascular, that exercises your heart. It doesn't exercise your muscles, but your heart. So that's good for you as well. It was a pretty interesting, especially because strength training, they talk about strength training versus running. To get the benefits of running or more of a cardiovascular exercise, you have to do 75 to 150 minutes a week. For strength training, you only have to do 30 minutes a week.
Incredible.
To get like initial big benefits. Obviously you can do a lot more, but just to get benefits. And they were saying the average person almost has like no muscle.
Yeah.
And so it's really more about just doing something, and then trying to do more, but don't do too much, because they also talked about those that get into like extreme bodybuilding and performance, then you start to hit the same decline that like an endurance athlete would get into, where it just taxes your body so much. Now, like, yeah, you'll have higher performance, but your longevity will diminish. So anyways, I thought you guys would find that an interesting conversation. You guys have both, I know, could add a lot to that too.
No, it's super interesting. I think, the big thing that's crazy about working out is once you build some level of muscle, I think the studies show it's like 1/9 the effort to keep it. So to your point, if you could start out lifting 3 or 4 times a week, and you have to eat more and be in a calorie surplus to build muscle. But once you do that for a while and you build some muscle, you could actually back off and still eat healthy and work out once a week. And you're going to maintain a lot of that muscle mass, which is really important as you age.
Yeah, it's like staying in shape is easier than getting in shape.
Yeah, that's right. And that's where I think the diet, why I said diet, I mean, I think it's like Tripp said, it's not one answer. I think we want to kind of get to like one answer a lot of times. And it's, if you're not sleeping good, that's terrible for your longevity. But if you're not eating good, if you're not feeding your body, that's going to be a problem. But on the running, I think what's interesting is I've always been more on the weightlifting side, less on the cardio side. But if you stay in zone 2, so which is, probably for us would be like a slower run, more of a controlled run, and don't go above like 140 beats per minute on your heart rate. And then if you don't do that excessively, that's probably a pretty good like balance for your heart, right? Because you're not stressing your heart. You're keeping your heart strong without pushing it over.
Yeah, there's a lot of studies that would say that also it's a fat burn zone.
Yeah.
So also it depends on why you're trying to run. Are you trying to increase VO2 max, or you're trying to burn fat, or you're trying to build endurance capacity? But if you watch people just running like the neighborhood or at a park, you'll notice a lot of people are probably pushing themselves harder than they should because they think it's healthy, but it's actually hurting them, which you feel bad, because like they probably hate what they're doing right now. It's like miserable. And really the balance should be, most of your workouts could be this like controlled, steady run, like you're saying, Tim. And then if you want to push yourself, have a couple of your workouts, like maybe 20% of them where you do some like really high intensity.
Like a HIIT workout. Like once. I think so what I'm doing is a HIIT workout once a week, and then 2 zone 2 runs, which is kind of like a run with a little bit of walking, but it's mostly running. But I'm really watching the heart rate. And then it's all lifting besides that.
Tripp, I think you're similar,
I do
right?
Monday, Wednesday, Friday. It's like a 45-minute lift that rotates every 6 weeks from like high rep, lower weight, and then back to like lower rep, higher weight, to get like a good mix and not like plateau. And then on the runs, I'll like kind of rotate with, I'll mainly only do zone 2, which is super boring. But every once in a while I'll like let it loose if I feel really good. But it's like trying to like burn fat on the runs. But honestly, the walks are like super underrated. So me and Allison try and go on like 2 to 4 2-mile walks a week, because it takes like 40, 45 minutes, and you get like pretty incredible results from just walking. Like I think people overlook walking pretty heavily, and that's for like stress management and for health.
Yeah. You get that time to connect. And I know you guys do nightly sauna, right? Tom, you and Jackie.
Yeah, we normally like to do the sauna every night. And I think that is probably way underrated. I really hadn't thought much about saunas. I know that's taken off more, but culturally there's other parts of the world where that's like a way of life for people. And I just think it's like a detox and a stress reliever. It's pretty amazing. So
50% reduction in all-cause mortality. The study you were quoting earlier with 4 times a week, which is, I don't know if there's anything else.
Especially
that really
something
does
where you're
that.
just sitting.
If you looked at
like
everything
you just
else,
go sit for 15 minutes, 4 days a week. It's like, that's pretty incredible.
Yeah, no, it's one of the most pleasant things you can do.
It's like, oh, let's get this workout
well,
in.
It's
sit, read a book.
It's a hack, but they were saying that if you sauna at the end of a workout, like at the end of a training workout, it'll actually increase your VO2 max, which is
interesting.
Which is good, because you can only train so much, and then your VO2 max will start to decline. But if you can sauna like right after a workout, and it'll increase it, which I thought was interesting, because I've had
probably because it's keeping your heart rate up maybe longer than it otherwise.
Heart rate up, but you're just sitting. Yeah, that's cool.
Yeah. So, anyways, I thought you guys would find that interesting conversation. There's a lot more to talk about there, because we only briefly mentioned sleep, but I think sleep is one of the really underrated areas, because I think a lot of people just get to where they're operating off of chronic sleep deprivation and just don't think they need as much sleep. And then it's also kind of I don't need sleep. I function off of a few hours of sleep, and it's kind of like a bragging thing, but it's actually just really bad for your body. and your
Yeah,
brain,
I
really
don't
bad for your
do that.
brain. So
I got to get the 8 hours.
Yeah, I feel it when I don't.
well, that was the thing about when, having kids, young kids, it's not sleeping for that long was tough,
Sure.
and we're getting to this stage now where even though we still have young kids, like it's a lot less frequent that I'm getting woken up, but going from like being able to go to bed and sleep through the night to having constant interruption is it's a hard adjustment. So I definitely realized the importance of sleep when I went through that.
Well, should we get rolling into the podcast part? This is almost turning to health and wellness.
That's right.
type
Let's do
slang,
it. Let's,
guys.
yeah, let's get into some
Which
of the.
I love. I could talk about this all day.
Yeah, well, I think that I think we can get into some of these scenarios that we've been running into. There's a couple that are pretty frequent that I'm experiencing here in the Dallas market, and I think it's just a function of the market we've been in, where a lot of land traded, probably a record amount of land traded for development by end of 2020 through the beginning of 2022. It's really crazy how short of a period of time that was. There's some developers that were still buying kind of late 22 and early 23, but because rates had gone up so much at that point, and we saw so many land sites fall out of contract. But now we're sitting in 2026. And so it's been 4 years, 5 years since a lot of these properties were purchased. And so several of the listings we're currently working on, developers have land that they purchased. They're not able to get out of the ground for a lot of different reasons, but a lot of it's just the market assumptions that they bought under, the way that rates went, the way that construction pricing went, where rents are in the market, demand. And they put debt on the sites thinking, this is just going to be a land loan that I'll probably have for 6 months, 12 months. And now that's stretched out. And some of these, they've had them again for 4 or 5 years. And so the debt's coming due. And so what we've been getting pretty frequently now is these requests to update BOVs, letting these landowners know, like, what's my property worth? We've been doing it on some of these for 2-3 years. And what I'm seeing is the value has stayed flat, if not declined over that time period. So initially, when rates went up and we were probably like 23, 24, there was a belief that by 25, things were really going to bounce back, survive to 25. And so land values weren't really declining. They were just kind of staying flat. And so there was actually a lot of optimism. But if you think about what's happened the last 18, 24 months, that optimism has almost kind of started to go away, because it's just, we've stayed pretty stagnant from a rent standpoint. And at least here in DFW, rents have declined on the apartment side. And so it's made it difficult for these developers to get out of the ground. And so then coming to a land broker and saying, what's my property worth? You have to realize, like, we're valuing so many properties. There's just so many options for buyers right now that it's more about, would someone actually be able to come close on this property? And there's the, what is it worth if I give someone a lot of time and, everything kind of falls into place? And then it's like, what's it worth if I just have to sell it? And those are the type of conversations we're having. And so I think the scenario I'm bringing forward, and I'm interested if you guys are seeing this in your markets, is I've got debt that's maybe due in the next 6 months. I've kind of kicked the can because I've been hoping that the market was going to bounce back and either I was going to be able to develop it, or it would just bounce back to the point of it'd be easier to sell. But now, with only 6 months left, I'm trying to decide what to do, because land just doesn't trade very quickly. And so what is my property worth? How would you position it in the market? And what should I do? Is the question that we're getting a lot here in Dallas. So interested in if you guys are seeing those type of scenarios in your markets.
Yeah, I'd be interested to know between the 3 markets, or which market has more of these, like especially multifamily sites that are developers are sitting on building. We do have some in Houston. I feel like maybe they're fewer than Dallas and Austin. It's kind of my perception. Some of the ones in Houston, unfortunately, are very difficult deals that you look at why they weren't built. There's a reason. The developer would ever paid for them. They're in markets that are, more difficult markets. In the suburbs, they would be more commodity sites that just can't get capitalized. And so they're going to have to go for a lot lower price for someone to buy them today. In the infill market, some of these were bought 5 years ago or 6 years ago. And so the pricing has just completely changed. And we actually have had some pretty good offers on some of these sites, but the developers weren't willing to come down, 20 to 30% off what they were wanting. And there just isn't a market, for these really high priced infill sites. And I'm talking, really like 150 to 200, or some cases 250, kind of per square foot numbers. We're just not seeing that in Houston. We're seeing some groups offer over 100, 100 to maybe 130, 140, which we think is really good right now for Houston infill land. But we're not seeing developers who bought sites at higher numbers want to get into that kind of mid 100 range to sell those.
Yeah, what are you seeing in Central Texas, Tripp?
If I had to guess, we probably have the most multifamily sites that are still sitting there. I mean, it'd be interesting to hear about. It's interesting that there's not that many in Houston. I'd be interested to compare it to Dallas too. But like for us, I mean, there's got to be at least 30 to 40 that are just sitting there that have been for the past like 3 to 4 years, not moving dirt. And, it's like we started BOVing them probably 3 years ago after they had sat for a year or so. And the price just continued to go down over the past 3 years. And I think it feels like most of these guys are getting to a point where it's like, hey, well, the developer wants to develop it. The equity is, it's coming closer towards the end of their fund. And so they want to get out, but the developer wants to build it, but can't capitalize it, even at what they bought it for. And so it's getting to this point where people are starting to feel jaded, I think. And I'm getting more phone calls, what feels like by the month, calling me saying, hey, like, we've got permits, or we've got, plans in hand, or we could pull permits tomorrow, or we've got all our zoning, but we can't do anything with it. Like, could you sell it? What could you sell it for? And it feels like we're getting closer to that point of getting these deals exited. But I think it's still pretty difficult, because unless a lot of these deals were unfortunately bought at the peak and the numbers just don't pencil today, and they've got holding costs and a couple $1 million in plans, and nobody really wants to build anyone else's plans. And so it's, I don't know, it's an interesting point of the market, because it feels like people want to go in new deals and make money. But I think there's going to have to be a correction on pricing. And so I think the people that actually have pain, or, are willing to like face the music and just be like, hey, let's take this loss and just move on and go do deals again. And then the question becomes like, okay, well, who buys those sites and which ones go first? And at least in Austin today, for equity, you've got to be a pretty good site and have a pretty good story. And so, the B plus or the B minus sites, I think, are going to have a really difficult time getting liquidated unless you just give it away. I mean, we've tried it on a few, and it's just really hard today.
Yeah, that's the challenge. Because I mean, if the reason the developer isn't building is they can't get it capitalized, which is probably the reason,
Like,
then
how could anyone else?
How can you sell it for this big number and the next guy gets it capitalized? I mean, in some cases you can, because in some cases the sponsor is not very strong, and you get a stronger group that has better capital relationships, and they're able to come in and still get it capitalized. So we do see that. But to your point, Tripp, when you have that many deals, you're probably going to have some deals get sold to more investor kind of buyers that have capital just to go close on the land, which we actually did see that. We marketed last year an infill site in Houston and an infill site in Dallas for a developer, and they both sold to developers who actually paid some pretty decent numbers. So that was a good example of what I think was a great execution, where the developer who sold didn't lose money.
It really is. Yeah, we're seeing that similarly on the urban infill. But again, like, that's where people want to live. That's where you're seeing strong rents. We saw some people get out on some sites that we sold and made a little bit of money, or broke even. But now that, they got to return that money, ultimately to themselves and their capital partners. But now they're getting to go do deals again, because, they didn't hurt that relationship, right? I think it's more in the suburbs where we're seeing that pain. But to me, the smart money, the smart guys are going, hey, let's cut our losses and move on and, mend this, because I think the slow bleed out doesn't help really anybody in any of those situations. So
it's interesting that we will run into a lot, the developers point you just made, Tim, that will they will actually have a pretty good site that we know we could go execute and bring a buyer to, but they have told themselves, like, if I can't develop it, then no one else can, and I can't actually sell it. And sometimes there actually is an ability, because every group does look at things differently. They have different capital structure. Maybe it's a asset allocation, just the ability to go do another project when someone else has a big pipeline. But we have seen those where we've brought someone in and they've been able to make a deal work. And it's interesting, what we're seeing in Dallas is sometimes it's just bringing in a completely different way of looking at the deal. So 3 of these recently, all deals we're working on right now that are at contract or under contract, we've brought in a 4% tax credit multifamily developer to a traditional multifamily development site. It's like owned by a multifamily developer. They bought the site with the intention of developing apartments, and now they're selling it to a tax credit developer. And what's interesting about it is, as you guys know, if you're in a tax credit zone and you can get the approval through the city, those developers can normally pay more than anyone else. And so it actually is a pretty good outcome. And some of those tax credit developers are getting pretty aggressive on timelines and willing to take a little bit more risk, because the bonds are there. So it's not really a question of will they get the bonds. It's just getting the approval from the city that they're not going to oppose the project. And then that's probably going to work. But I was just going to say that's just another way we're looking at these deals is we're looking at deals from a lot of different angles. And I think a lot of times what will happen with a landowner is they're really focused on the way they had approached the deal and the way they had looked at it and thinking that's really the only way to get out of it.
Yeah, that's right. And that's a common thing that you're right. The bigger danger is not who's going to capitalize this, but people thinking, why even try? Because if I can't get it done, no one can get it done, which a lot of times is not true. But I was going to also ask you guys, because you guys have a lot more build to rent in your markets. We have a deal in Houston. Actually, it's a good site, but the group has build to rent plans and will only sell the site if you buy the plans. And so we could actually bring a buyer to buy what they want for the site. But the problem is when you add the plans on, the deal doesn't work. And it's just a lot there. It's a lost cost. Are you guys seeing that in your markets? Some of these build to rent deals, and this is not a build to rent site. No one wants to do build to rent this site. It's probably more of an industrial site. So I just was curious what you guys were seeing with that.
We're definitely seeing it on build to rent and multi sites where guys have plans in hand and they're like, yeah, you got to accommodate me for these. And guys, the market today is a lot different from where it was 3 years ago. And they're like, well, on top of, everyone kind of having their own ego and looks at things. And so they're like, I don't want to build your plans, or I don't like this layout, or I don't like this facade. And so most of the time people are like, well, those are worthless to me. But to that owner or that developer, like, well, I'm $2 million in, like I need to be compensated for that. And to your point, Tim, it's like the land's already expensive as is. And then it doesn't make the deal work. So, I mean, we've probably got 20 plus deals like that are just sitting. Because if you could just buy the land, I think you could get away with it with some time. But the plans just make the deal not pencil today.
I'm trying to think, have we ever, and I'm sure we have we ever had someone buy plans? I think it's almost always a loss. I'm trying to think. I'm sure that there's a time that someone's actually paid for the plans. But can you guys think of that in your markets?
Yeah, we've started to see it quite a bit up here. I think it's just a function of the timing in the market. So I hadn't really seen it early in my career, but now I think it's just because there's so many developers that have gotten stuck in deals and they put money into plans. Yeah. And now, there's been this openness to take on plans that we've seen up here because developers, especially right now, see the benefit of lower construction pricing. So versus sign up a raw piece of land and go back through permits and kind of go and restart on something, you could be under construction right now and you can guarantee the pricing.
We're starting to see that too, Tom.
Yeah.
We're starting to get phone calls in this last quarter. Even I've probably had 5 groups reach out and be like, hey, do you have anything with plans in hand that we could go and just move on quickly? Because it's more of a function of timing. And it's like, if you want to edit them a little bit, it's like, go ahead. But to your point, it helps a ton with construction costs and execution and just getting something in the ground from a timing standpoint, that you do really well. So we're starting to see the same thing.
Yeah, we actually closed a deal last year where they even broke it out, like in the closing. There was a land value and there was a plans value, so it wasn't just kind of because you'll also see it just lumped in where it's like, hey, we'll pay $8 million and that includes the plans. But on this other one that we did, they actually bought the plans and they built the plans. Because a lot of times you're gonna value engineer some of it and make some changes. I think we've seen better consultants that guys have been using, and so that's helped. So there's a lot of these deals where the developer will say, I have plans, and then they're using a good architect. They had a good civil engineer. That helps a lot because then the other developers that are looking at it have a level of comfort that this is a good project.
Yeah.
I think back in the day when we would see those type of deals, it was just fewer and far between. And a lot of times the consultants were just less known. And maybe the person had never built apartments before. And so it was just harder to get another developer to want to go build those plans.
Question for you on that last one, Tom. Did we get paid on the dirt and the plans?
No, we got paid on the dirt. That's why I remember that they broke it out that way.
They broke it out, screwing the broker.
Yeah, it was like, I think the plans, it was like 1.2 million. So that's not a
It's like, hey, we should get paid extra for getting you to buy the plans, someone to buy the plans.
We're starting a plans investment platform, so it's all good. It's coming soon.
That's right, yeah. So I have a question for you guys. I had a client reach out yesterday, and they have a $50 million investment they want to make in Houston in land. And they were reaching out like, what are you seeing? What deals? Where would you put this money? So where would you guys, if you got that call, I know you guys are working with those kind of clients in your markets, where would you, if it was more discretionary, where would you say like, here's where I put $50 million in my market today? this is where I could get the best return.
Sure, yeah. I'd say like for Austin, certainly, I mean, this is like, of course, but urban infill covered land is ideal. The problem that we run into is not as much. Like I can see people getting over the cap rate, being pretty low. It's more just finding something that has a lease where you can actually get to the dirt in like a, normal timeline. But urban infill, Austin, I think is always a no-brainer just because it's where people want to live. It's where the activity's happening. It's where all the cool stuff is. And it's where you see all the, the rent growth and, the really strong exits. And so outside of that, I would probably try and focus on, suburban land where I think the single family or industrial or potentially multifamily market comes back. It's probably a larger acreage tract that might have a couple of different uses that's like really well located, that's got access to plenty of, water and sewer utilities, kind of similar to our Georgetown deal where you anticipate the market coming back. But yeah, I'd say urban infill covered land, or if it's just a really good story on a raw land site, the urban infill, really well located larger tracts in the suburbs.
Yeah, I think that it would somewhat depend on what they're trying to accomplish, like what their hold period is and what type of returns they're looking for. And because that's gonna dictate whether or not you're going to want to go a little bit more suburban and maybe make sure you have lower carry costs. Because, the urban markets, like to your point, Tripp, are a really good investment, but carry costs could just be higher. So it's just trying to understand what they'd be trying to accomplish. So up here in DFW, I just don't think you want to bet against the growth north. And so I think you want to invest up north. I think right now there's an opportunity to be more in some of the core areas. So before, if you were investing in the frontier, like further and further north, up towards Oklahoma. Right now, I think there'd be an opportunity to invest back a little bit closer in and see what you could find in Plano and Frisco and some more of these core areas. I think obviously try not to go after heavily marketed sites because I think that's where there's still some pretty high numbers being paid in some of those better areas. But we're also finding some really interesting opportunities in some better areas because the general activity is just down in the market. So it makes it a unique time for a land investor to be able to go and explore some of these better areas.
You bring up a good point because it also makes you wonder, is that investor, willing to spend a little bit of money on entitlements or bringing utilities to the site, and then also, their hold period, depending on how much their money costs and what it's going to cost them to hold the land. I think that might change my answers a little bit, but yeah. Specifically on the suburbs, I would also probably say like as near north as you could get towards Austin, between here and Liberty Hill, and then probably like West Austin, where again where you have really strong demographics, really good schools, a lot of the growth's happening, but there's high barriers to entry. But yeah, you bring up a really good point, Tim. What about you for Houston?
Yeah, I was gonna say, I mean, I think from a timing standpoint with land, you pretty much have to be 3 to 5 years. I mean, you can get lucky and it can go a lot faster, and we've seen that many times. But land just typically it doesn't move that fast, and so to come in and buy and then get probably if it's unlevered a 1.5 to 2 multiple, it's going to take some time. I would say the two areas I really like. One is the infill market because Houston's been so beat up. There's hardly any infill deals happening, and there's some good like fringe infill like the western part of the Heights that's really starting to open up where you can still buy land in the $40 to $50 a foot range, but I think it'll be worth $80 to $100 a foot in the next couple of years. Some kind of close in Spring Branch, like around on the north side of I-10, kind of Gessner area, north of City Center. There's some really good pockets there. The other area I really like is that Waller corridor up 290. And I think with $50 million, buying some like a bigger tract, like 100 acres, 200 acres, that probably today could be bought in more single family pricing or even lower than that, somewhere in the $1 to $2 range. But it could be a long-term commercial tract, maybe a mixed use, some single family, some commercial. I think it's just an incredible corridor. We're going to see a lot of growth out there over the next 5 to 10 years. So there are certain areas where you feel like it's going to be hard to lose. If you can be patient and you don't know the timing, it's like maybe it's going to be 2 years or 3 years on the short side if everything just aligns, or it could be 7 or 8 years, or it could be 10 years. But the chances of actually losing money and not seeing a really good gain over that period are pretty low. And the good thing about some of these more rural tracks is they're in ag. So from a carry cost standpoint, like you were saying, Tom, you're really low cost to carry. You're just waiting on the growth. The infill market, you're going to probably have a cost to carry unless you have a covered land play, which some of these sites do have old industrial on them that have tenants or other kind of commercial tenants that can kind of help float you.
Yeah, these urban markets have been difficult in all of our markets because there's been less investment, in the last couple of years, and so prices were a lot higher than they are. Because I hear about a lot of the prices, Tim, that you mentioned in Houston, and they're very similar, if not lower, than when Tripp and I were there making offers and working on stuff, 6-7 years ago.
I would say they're significantly lower because you were in probably the high watermark or close to high watermark of pricing, and there's just almost no activity, so it's come down.
And so that's what's hard because when you said 3 to 5 years, my thought went by the opposite of what you were thinking. Because then you said, sometimes it can be quicker. And my thought was really a lot of times it's going to be longer. I think to do a 2X on a land deal, sure, you get lucky. But to do a 2X, to take $50 million and 2X it on land in 3 to 5 years, unless you put it all in one deal and you get lucky, is going to be extremely difficult. Extremely difficult in 3 to 5 years. 3 to 5 years goes so fast.
Well, and that's why I said those specific areas, because those are areas I believe you can do that in 3 to 5 years. And part of it is because it's been so beaten up in the infill market the last couple of years, and we're seeing the land prices come down to where they are. I think that, and now we're actually seeing some good development come in, like more mixed use kind of development that's really changing the area, helping gentrify faster. I think those areas, I would bet you can see that kind of a investment return in that time frame in those pockets. There's other pockets I would say you could be in there for 10 years and it's not going to happen. I mean, it could, but it's just like I feel like it's a lot riskier.
Same. It's a lot of it's like submarket dependent because I could think of plenty of tracks that we could look at to buy right now, but it's like, man, to hit a 2X, it's like, it could easily be 10 years. And I would agree with you, Tom, generally. I think a lot of that just depends on, can you buy it right? That's the harder piece because it's like, well, if you can buy it right, then but, finding that deal is kind of like the needle in the haystack when you're getting it, at 25 cents on the dollar.
Yeah, like a good example in Houston, I really like Greenway Plaza for developers, mainly because it has gotten beaten up. So you can probably get a good site like on the $125 to $150 foot range. And I think you could build a deal there and make money. But I would not say to go buy that as an investor because I don't think it's going to be worth $200 to $250 a foot in the next 5 years. I mean, I think it'd be worth 160, 170, but I think we're in the infill market, you have to find the sites where you think it could double. And that's just not going to be very many sites. It's going to be these areas where there is real gentrification. They're close enough for things to change. So when there's momentum in the market, developers go there first, and then they just start to pay up to get them to closer where pricing is in the other hotter part of the infill market.
From a use standpoint, I was thinking of a similar train of thought, Tim, to that question about just like where to develop. It would be like what uses to bet on for the next 3 to 5 years. And it's hard for me not just to go to data centers and industrial. And really just industrial is benefiting so much from all the AI data center activity. But especially in the Austin area and the Dallas area and even in Houston, even though Houston's had less data center activity historically, I just think there's going to be such a need for that if I'm an investor looking at where do I want to put money and position myself, I think that industrial and data centers would be at the very top of my list because I think that we really are still undersupplied and it's really just issues we have around supply needing more. On single family and on multifamily, there's going to be pockets that make sense, but there's also a lot of oversupply of those uses right now.
Yeah, I mean, we're definitely bouncing along the bottom, I think, for multifamily, just with rents as soft as they are and absorption saw. I mean, at least in Houston, it's not a good story. Hopefully that changes, but to your point, it's hard to get super excited about it.
Yeah, that is pretty interesting, Tom. I didn't think about that too, because I think here we're tracking 70 data centers that are like under contract or proposed, which not 10% of those will get done soon, just because every pocket I found a new data center site yesterday, and the guys, were talking, and I was like, well, man, I think power is at least 5 years out for this pocket. But if you could be patient and buy it right and buy like a well-located data center site where you have some other exit optionality, where it's almost like your data center is like grand slam in the ninth inning kind of deal, but you could still sell it for like industrial or even a single family use and make money. That's a really interesting idea. And if you can be patient, you could go and potentially work on getting some of that power if you're willing to invest some of the money for that upside too.
Yeah, and I think that even Tripp, if a lot of those data centers got
We're
built,
still going to need more.
their compute needs are
Yeah.
so high that it's,
Yeah.
and then there's obviously power needs too. But I just think we haven't even really experienced or seen what's going to happen with robotics yet. And so the
Yeah.
demands for industrial manufacturing and all that are
Yeah.
going to come up, and also all the self-driving vehicles and charging stations and just the needs for all of the support around just the change we're going to see over the next couple of years. That'd be an area to really just think through as an investor, knowing that things are going to change pretty significantly from where they've been.
Yeah.
Yeah, I think that's right.
What about you, Tripp? What are you seeing question-wise, just scenario-wise, that you're running into that's maybe a little bit unique to your market, but could be applicable to ours, whether it's a client or a land developer asking?
I've got one. Actually, I've got a handful like this, but I've got one up north where I don't know if you guys are running up into this as well, but we've got a landowner that is a developer that bought the site, kind of peak of market. It's a pretty big site. It was a proposed build to rent project, but it was, going to be close to 600 units. And yeah, just bought it at the peak, and the city kind of messed around and, said that give us sewer, but couldn't really deliver on that, which is a whole different probably podcast conversation on legalities around that. But yeah, they're basically in a really tough spot. And so we continue to update valuations, and I'm having a conversation with them now quarterly, basically discussing on how they can ultimately get out of this. The good thing for them is their cost of capital is really low. So they can be patient. And I just told them, if that's the case, then let's just be patient and let the market come to us. Fortunately for them, the cost of capital is low, but it is interesting because it's in a submarket where, single family still active, but they still can't get that aggressive on land. And we paid a lot for the dirt. And then, multifamily is not quite there yet, but you can definitely tell that there will be demand probably in the next 24 months. And it just doesn't have a retail component. Unfortunately, it's just not on a hard corner, but we're having a lot of conversations with owners, particularly developer owned sites that, are larger or where they're just trying to get out. And it's just mainly educating them and keeping them up to date on a quarterly basis. But for the most part, I continue to tell land sellers and owners or developer clients, like, hey, if you don't have to, and your cost of capital is really low and you have no debt, and it's like, assuming it's a good site, it's like, hey, let's wait it out over the next like 12, 18 months, because I think things will start to heat back up in 27. And then for the guys that are in the opposite situation where they do have a lot of debt, or, they're getting pressure from the equity partner, it's like, hey, cut your losses, like take your $2 million haircut and move on and go, make money again.
Yeah, it's interesting because it is going to depend on the situation. What's difficult in trying to call it black and white is, even if things come back, what does that actually mean for that property? And what does it mean for how long it will then take to sell that property? And what does it mean for the value? Because I don't think what any of us really believe is that if properties were, let's just say, selling at $30,000 a unit for multifamily, and now that property is like a $15,000 a unit, then in 12 months, it's like back to 30. It almost could be that in 12 months, it's just back to like it could close. Like actually somebody could probably get it done, because you're either looking at closing will happen because someone is going to be able to build it, which that is like a massive hurdle to overcome on these deals, right? Just getting to the point where you could build it. Or it happens because someone's willing to just buy the land again and put themselves kind of back in the same position that the current owner's in. And so it is different in each situation, but it's trying to help these developers think down the road. What if 2 years from now you still own it? Are you okay with that? And then if we're now going to contract in 2 years, then it's maybe closing 9 months after that, right? Because it doesn't happen instantly. And then what if the value is not 15 a door? What if it's 18 a door? Was it worth it to hold it for almost 3 years longer to get from 15 to 18? Especially if your basis might be 25, or your basis is going up that whole time. By the time you sell it in 3 years, your basis might now be 19 a door instead of 50. So those are like some of those real conversations we're having. And it's
the only real reason to hold it is probably if it's going to almost like double, don't you think? I mean, it would be, if I sell it now, it's a 50% haircut. Well, it's a really tough sale because it's an investor. But if I hold it now, someone can capitalize it and I can get out in my basis or higher, and that's 50% higher than what I can sell today. If you're looking at it's 10 or 15 or 20% less today versus 3 years from now, I think it's crazy to hold it.
Oh yeah. I think the only scenario where it's like hold it as if you're in a really good basis, but it's tough, but it's got a story. But only scenario I see where they hold it and get out, where they make money is if you let the market come back and it's a developer and they can go develop it and make money. Like that's the way. But if you're like holding to sell, it's like, no, just take your loss now.
I think one of the biggest problems is just like people living in reality on what it's worth. Because sometimes you get these people where they mark it up, whether it's on paper in their mind or whatever, and it's like this is a $200 foot site, and it's like it was never a $200 foot site. It's a $130 to $150 foot site. So then it's like, well, if we can get you an offer at 150, which is just like hitting it out of the park, in their mind, they're like, that's a $50 foot haircut.
That's the
and you're like,
hardest.
Well, not really. It's not worth $200 a foot. It's not you know what I mean. But we'll get people all the time where like they bought it at a lower number. They're mentally marked it up really high. Like there's one in Houston like this where they're marking up way above what they paid for it, and it's not the market's never been there. But in their mind, that's market. And if they sell for less than that, they're selling below market. So some of this is just like, you have to be realistic about what is your site actually worth? And was it ever really worth maybe the number that you've told your equity partner? And maybe that's part of the problem is they've told an equity partner it's worth some huge number that was always aspirational, but it's never been worth that.
Oh yeah. I'm having those conversations weekly. I'd say like over half of our market doesn't live in this place that we live in, and it's called reality. So weekly conversations where it's like, hey, proposal. Hey man, sure, like it's going to be in the 15 to 20 door range. It's a garden site in Round Rock. It's really tough. There's still a lot of supply. Rent's really tough. It's not going to do it. I'm like, okay, yeah, no worries. And then they go get BOVs from competitors, go out to market at, 25 to 30 a door, sits. It's just, yeah. I mean, there's a lot of that, unfortunately, but a lot of it's like pressure too from them, which I feel for some of them, but a lot of them are like completely out of reality.
I think this will resonate with you guys. How many times have you been negotiating a deal and the landowner wants you to close 60 days sooner? Yeah. And so then for like 3 months, you're arguing back and forth over the 60 days. Well, now we're seeing the same thing with developers. So they're stuck in their deal. You'll bring them a good offer. And it's like, oh, well, it's a 9-month close. I'm not going to give somebody 9 months to buy this property. It's really funny because like developers are really bad sellers because they'll require something of someone else that they would never do.
That they would never do themselves. We're seeing that.
Yeah,
all
it's
the
like the
time.
developer that, every offer they ever make us is a 15 to 18 month close with all kinds of, extensions. And then you bring them an offer for like a 9-month close and they're like, this is an option contract. It's tying it up.
Funny.
And and you're
funny.
like, okay, well, you're not able to get out of the site. I'm not gonna like rub that in your face, right? But it's like, you're not able to get out of the site. I brought you an offer that maybe like even like makes you money. And with some of these, we're now 2 years later and we keep bringing them these offers and they keep saying these will waste my time, but they haven't ever gone under contract with any of these buyers. And so now what's happening? We're bringing the same offers 2 years later. It's like the offers aren't suddenly going to now be 60-day closes at that value. So it's really interesting how that goes.
Oh, if these people, there's countless deals where it's like we've offered, you go back and forth, you argue. It's like, had you just signed that contract, 3 months, like when we started this conversation and just said, okay, let's do it. It's like, it'd be closed by today or 3 months. It's like it meets those timelines. And instead it's like you're 3 months later and the market's gotten worse.
You got to take the emotion.
It's so painful. It's crazy how true it is across all our markets.
Well, you got to take the emotion out of it because we've talked about in the past, a lot of times the driving factor on these deals is someone doesn't want to make a mistake or doesn't want to admit that they made a mistake or made a bad deal. And that's more important than maybe moving forward and make the like logical, rational decision. Because if you do move forward to sell at a loss, even if that's what's best and makes the most sense from a business standpoint, you're now acknowledging that you made a bad buy. And unfortunately, the whole like you made a bad buy, I mean, a lot of people made decisions that they wish they hadn't made now, but the market also adjusted so quickly, like overnight, that at the same time, it's for a lot of these guys that put themselves in the position they're in, it wasn't really their fault. I mean, this happened to so many people.
Yeah, it's not like anyone saw it coming or they wouldn't have done it. And it's like, it's not really admitting it, it's not as much like, hey, I made a bad buy. It's like the market turned and I caught the short end of the stick, but it's like, let's use logic and move on. But, logic's a wild thing to
I was listening to a podcast about this. They're talking about fearing loss and then like experiencing a loss, how the brain is so avoids that so hard that we're willing to tell ourselves stories so that we don't have to like experience that. And they're
Yeah.
actually saying that like experiencing like a gain is less like obviously you want that, but it's less of an issue for the brain than avoiding loss. And
Yeah.
I think that's kind of interesting. Like people will almost believe anything, even like really smart people who are like, hey, you've been in the business for a long time. I know that you know this is crazy, but they're trying so hard not to experience that loss and to avoid that, that they'll say things that are not even like rational, that have nothing to do with reality, because they won't admit that their pricing is out of whack.
Oh, yeah. I talked to this group the other day, and I won't share the details and too much, but basically, yeah, they just came out and were like, I've been doing this for 20 years, and my property's just like for every day they don't buy it, the value's just going up. And I was like, man, that's wild. I didn't know how that's how it works. That's good for you, And he was just like, well, and I'm like, so yeah, I mean, explain it to me, like, and I obviously like I didn't get into it, but it is interesting because Tim, it is so much of it is this there's this emotion that's involved, and it's your psyche
Mhm.
coming in and basically being like, well, I don't want to experience that loss. So I'm going to tell myself that I have this great property when in reality this guy has like brutal access. He has a very real buyer next door that's making him a fair offer where he still makes money. But he's like, well, this market's
Gosh.
booming and I'm gonna, it's gonna come back. And I was like, yeah, I mean, if you don't have to sell it and you don't have any debt, we'll wait for the single family market there to come back. You're probably gonna have to wait 2 or 3 years, but it's like tried to explain it to him, but I'm like, without their access, it's like that just devalued your property and they're your buyer. He's not going that direction. And then what he doesn't know is that there's 9 other communities that are coming online within
Yeah.
5 mile radius.
Yeah.
And all those builders are going to go to those lots that have a better site with better access where they can buy lots probably for cheaper instead of just
Yeah.
taking money and getting out now. But yeah, I'd say that's probably the hardest part of or my business is dealing with sellers that are avoiding like this loss basically and making up
It's like one of the
stories.
biggest things in life. If you can just deal in reality and admit, like move on, like admit you made a mistake, or admit that like maybe like you said the market changed, it's not your fault. Like just let like accept that loss, move on, and make smart decisions. It's so much better than just holding on and holding on. It becomes a much bigger loss the longer you hold.
Oh, yeah, and it's also, like, super interesting because if you think about the time that you spend, making up the story or trying to
Yeah.
hold on, if you would just, like, go and take that loss, I mean, it's like it's happened to me before with investments, other scenarios where it's
Yeah.
like something didn't work out. I don't let it bother me. It's like you move on and then you can go
Yeah.
and invest in something better or find the next new deal and focus on the positives instead of getting so stuck in the past. But yeah, I mean, reality, if everyone would operate in reality, it'd be great. It's also interesting working with people that are really smart and have made a ton of money and they do live in reality. And they're like, hey man,
Yeah.
let's just get out of this and let's go move on and go make more deals. And frankly, the people that act like that, in my experience, make a lot more money and are generally
Oh
like more
yeah.
happy too.
They're doing something positive. Yeah, it's
Exactly.
super freeing. Move on from a loss
Yeah, like
that
you
you
don't
can't do anything to make it a win. Just move on from
absolutely.
it and then go do something that can be a win.
Yeah.
Yeah, think about pushing, like living through another 5 or 10 years of trying to make a loss a win if it's not going to happen. And just the stress with your investors, and just what that's
Yeah.
going to do to you. I think that's why for us with Ascent, because we're a seller all the time, we always tell our investors, like, this is what we think. We'll buy this property, this is our underwriting. But if somebody comes along like quicker than what we expected, like we just sold those 2 properties in McKinney. We underwrote those to be 3 to 4 year holds to play off of the airport expansion and all the growth. But a group came along within the first couple months of us owning the property and made us a really good offer. And we were like, this is going to be a really good outcome. Let's take this instead of just like, well, it could be better if we held it another 2 or 3 years. And by having that kind of an attitude, we've been able to buy and sell and actually do so many more deals. And our investors love it because
Yeah.
these are experienced investors that have been through a lot, and they know that like the future doesn't always play out the way that you think it will. And
Never does.
it's really bad.
Never,
It's
yeah,
really,
rarely does it.
yeah, it's really bad if you look back and you say, we should have. Like, we
Yeah.
should have taken that offer. I mean, if you don't have the
Oh,
offer,
it's
you don't
the
have the offer.
worst.
But like, we're always like, look, if we can take a win, let's take a win and get it off the table. And then, when you realize something that's going to be difficult, like you guys are saying, it's like, let's really focus on getting that sold. and because I think it just gets worse. Carry goes up over time. You get deal fatigue. Returns are going to come down.
Well,
So it's like, just get it sold.
I mean, it's kind of, it's like kind of like this gambler's fallacy. It's like you think about it, it's like you're at a blackjack table and you're like, you get up and you're like, oh man, it's like I could probably get more. It's like people just getting greedy. It's like, man, take your chips off the table and move on. I see that all the time with, it's interesting. I see that all the time with like these really smart guys that aren't greedy. They're literally like, no man, bird in hand, like let's take it. And then to our point, it's like you go take your chips off the table and then go make that money make money. Where it's like, okay, versus the other guys that, I'm dealing with this with land sellers right now. If I got paid $100 for every, I should have taken that offer, I wouldn't even be working right now. I'd be retired.
Yeah.
Because so many people were like, man, like I had some guy text me yesterday, a landowner that, he bought this site at the Peak, and he said, hey, what was our best offer at? I was like, well, it's $6.5 million. And we countered at $7.5 million and cut their time in half.
Yeah.
And now the site's maybe worth like 3.5. And it, it'd be well closed by now. And it's just like, man, it's just so, but it's also super insightful. And like, super easy to talk about this in hindsight, but I think it's just a good reminder for all of us that it's like, it's not always about maximizing the return. It's really like picking the right buyer that's actually going to close, And I think that could go a long way for us and our land seller clients.
And I think that investors actually appreciate when a sponsor does the right thing and makes the hard decision that's the rational decision. I mean, I'm that way. When I'm in investments, and if it's not a great sale, but I get my money out, and I understand that the sponsor made the best decision they could under the situation, I would much rather that than them like kind of taking another 3 or 4 years, just kind of hoping on a dream that we're going to make more money, because you normally get less money and your capital is tied up for 4 more years. So I think that people respect, like you're saying, Tripp, when people make good, rational decisions, and it may not be like what the outcome you wanted, but it's the best outcome you can get. I respect that a lot. I think that's what defines like the really like shrewd, strong business people versus the people that are almost more amateurs or just letting emotion dictate what they do.
Oh yeah. Every time I put money into an investment, I just act as if it's gone. So I'm like, okay, that I'm never seeing that money again. And if someone comes back and is like, I mean, yeah, because that's what you're doing basically. You're taking the risk because it could go to zero. And so I just assume that every time. And then if I, every time I get the K1 and we exit, I'm just like, oh, great. It's like this money popped up out of thin air. But I would much rather people come out and say, hey man, like I got your money back. Like we didn't make anything, but we didn't lose anything. Would way rather someone do that and use logic instead of like it bleeding out and then making more capital calls, and which again is all situational. But yeah, logic is it is super respectful, and I appreciate it when people make the hard decisions. And sometimes we obviously have to do that a lot too. So
well, that's probably a good way to wrap the episode today. I think that's a good conversation. I think that it sounds like we're all talking about a lot of the same things just because of the market we've been in, and a lot of our listeners are making these decisions and thinking through this about deals they own, deals they're looking at. And maybe you own a deal and might feel like there's no way this can get developed right now. And we're actually working on some of those where we are bringing in other buyers that are getting people out of deals. And to your point, Tim, about the 2 from last year, there's actually been several where we've not only helped someone sell a site they have, but they've actually made money, which is pretty amazing considering these were transactions, these were deals that were bought at the height of the market. And then in some cases, you can actually sell them at a profit. So
yeah, and in those specific deals, we had a lot of people in the market that were strong buyers. They said, you'll never sell that for what we sold it for. So I think it's a good point. You don't need 20 buyers or 30 buyers. You really need one. And a lot of times we'll get maybe 10 or 15 offers, and we'll get 2 or 3 really strong offers. And then a lot of offers that it can be 30 or 40% lower on price or poor terms. And you just need that one to actually close. So that's a good thing to remember.
Mm-hmm. Yeah, that's a really good point, Tom. I'd say for any of you guys listening out there and you have sites that you need to sell, call us. We can help talk through it with you and see what the best way to exit is. Because there's probably an opportunity to get out and go make some money instead of focusing on the negative. So,
well, thanks to our audience for listening. Please hit the subscribe button. We were looking, and I think that a very small percentage of our listener base is actually subscribed. So it would mean a lot if you would hit that subscribe button. Give us a review on Apple or Spotify or wherever you're listening. That helps a lot. And we're looking forward to more conversations like this here in the future. Thanks, Tim. Thanks, Tripp.
Thanks, guys.
Thanks, guys.
Thank you for listening to our podcast today. If you have questions about land you own in Texas, send us an email at texaslandguys@dmre.com and follow us on LinkedIn to stay updated.